Okay, so now we're kind of getting into the meat of it. We've now gotten through all the preambles. We've talked about the different types of businesses, how businesses make money, what the triple bottom line is. And now we're kind of really going to start introducing the accounting content that we're going to be focusing on for the next several units. So financial statements are the ways that companies express to the outside world how they've been doing. And there are standards and rules that guide how financial statements are prepared. These rules are what are called generally accepted accounting principles, or GAAP, GAAP. And we're not really going to go into much detail at all about what GAAP says need to be done in the context of the financial statements. But what you do need to know, and know well, right? This is the heart of financial accounting. There are 4 financial statements. Now, we've already sort of alluded to 3 of them, and the 4th is really sort of a connector. So here we go. The income statement. Now, this is Hershey's income statement. These are reported in millions, right? So that's $6 billion, $644 million in revenue for the year, right? So those are all the chocolate bars and everything else that Hershey sells. That's all the revenue that they earned. And then the cost of those sales, so the direct costs associated with making all that chocolate, etc., is 3.7 billion. And then the selling and administrative expenses associated with marketing and distributing and administering the business and all that is another 1.7. It costs them $96 million to pay interest on the loans that they have outstanding. They had to spend $354 million in income taxes on the income of the business. They had some other expenses, right? So that added up to $5.9 billion in total expenses. You subtract that 5.9 from 6.6 in revenues, and that gives you $661 million in net income, which is another word for profit. Okay, so net income is another word for profit. An income statement is a summary of the revenues and expenses for a specific period in time. So income statements can be generated monthly, they can be generated quarterly, or they can be generated yearly. And you find out what the period of time is by looking up here in the header. And then it reports the change in financial condition due to the operations of a company. So that's an important distinction to make. And again, we'll get more of this. This is only the beginning. You don't have to understand everything about it at this point, right? But we'll get way more into this later on. Okay, so the income statement tells you whether you're profitable. Now, the statement of stockholders' equity is, as I said, sort of a connector statement that allows you to get between the income statement and the balance sheet. So here we have that $661 million in net income from the year. Retained earnings is the profit that a company has kept internally. It has retained its earnings. It has, over the course of the life, it retained $4.7 billion. It began the period with $4.7 billion in retained earnings. Because of the profit that it incurred over the course of the year, it increased that retained earnings by 661. And then they shared that profit with the owners by distributing dividends. So that reduced the retained earnings. So that means that at the end of the day, their retained earnings increased. And again, I don't think you guys, I don't expect you to understand all this stuff. I realize that this particular way that this particular textbook explains things, it kind of starts in the middle, right? So we're just getting the lay of the land here. Don't worry if you don't understand it. Okay, you just see how this number here, the 661, is what we got from the other statement. we reduce that by distributing dividends, and that leaves us with a balance in retained earnings at the end of the day of $5 billion. Right, so this is the statement of of stockholders' equity. This is also sometimes called the statement of retained earnings. That's why I kind of stumbled over my words. What you find in accounting is that different organizations, different textbooks, different professors will use different words for the same concepts. It does become kind of confusing. I get that. Okay, the next statement that we're going to look at is a balance sheet, and this is a snapshot. It tells you where you stand at a particular point in time. Okay, you'll notice that up here in the header, it doesn't say for the year ended. It just says this is the balance sheet as of December 31st. And the thing in the balance sheet, right, these are all asset accounts. And so, we're not going to go into a lot of detail about the definition of each of these, but assets, what assets are what you own. They are the things of value that a company can use to generate profit. So all of these things that a company owns, including their inventory, so all that chocolate they have sitting around waiting to be sold, all the buildings that they have, their property, plant, and equipment, all the chocolate making machines, those are all assets. They're going to be used to generate profit. Those add up to $4.7 billion. And then liabilities are monies that you owe to creditors, either accounts payable, which are monies that you owe to your suppliers, or other debt. Notes are like bank notes. Those are loans that you've taken out. So those $3.7 billion in liabilities. And then if we look here, right, stockholders' equity is all the money that the owners of the company or that the stockholders have invested in the company. So $579 million exists in capital stock, and then $5 billion exists in retained earnings, which are the profits that have been left in the company. Okay, leading to, now they did some stock repurchases, etc., so that reduced their owner's equity by $4.5 billion, and at the end of the day, right here, they have got $1.048 billion in stockholders' equity. If you add up the stockholders' equity and the liabilities, you get to this $4.7 billion number, which is the same as this $4.7 billion up here, and that is key. Okay, this is something that we are going to be practicing in the homework set, right? This is where the quantitative aspect of this class comes in. The accounting equation requires that transactions are recorded in such a way that assets are always equal to liabilities plus equity. That's why your balance sheet is called a balance sheet, because the assets, 4.7 million, balances the liabilities and stockholders' equity. Okay, that's a balance sheet. Now the statement of cash flows tells you how a company is spending its cash. This is all derived from the other statements. And we're going to go into a little bit of detail on this later in this module, just a little bit of detail. But what I want to note is that the cash flows are divided into 3 different general categories: operating activities, investing activities, and financing activities. And at the end of the day, this tells you what has been the cause of any change in cash over the year. Right here we have an increase of $35 million in cash over the year, and it tells you where that increase came from. Okay? Now I'll have you do a quick concept check on this stuff, and then we will move on to just a little bit more about how these statements are related and how we think about cash flow.